Insurance claims and the management of insurance claims. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses insurance claims and the management of insurance claims. In this video, you will understand the meaning of insurance contract, benefits of insurance claims, the importance of claims management in the insurance sector, goals of an insurance claims function, roles of insurance claims personnel, skills and qualities of claims personnel, factors influencing insurers' claims environment, dimensions of claims transformation, benefits of a good claims handling process, obstacles to the transformation of claims handling system, consequences of an untransformed claims system, implications of customers' experience on insurance claims processing, how to improve insurance claims handling process, steps of the insurance claims process, insurance dispute, how to resolve insurance disputes, and principles and conditions of insurance claims processing. Now, let us start. Insurance contract. A contract is a legally binding agreement between two or more parties whereby rights are acquired by one or more parties to act or forbearances on the part of the other. Insurance is a contract between two parties, the insured and the insurer, whereby the insurer undertakes to make good a loss of the insured caused by specified perils during the contract period in exchange for a consideration known as the premium. Insurance is the pooling of fortuitous losses by transferring such risks to insurers, who agree to indemnify insureds for such losses, provide other pecuniary benefits on their occurrence, or render services connected with the risk. Individuals, households, and businesses can purchase insurance policies to manage their risk exposures. All risks proposed are assessed by the insurer to ensure that each insured pays a commensurate premium, and appropriate terms and conditions are included in the insurance policy. Hence, insurance may be viewed as the custodian or treasurer of the fund. Benefits of insurance. Benefits of insurance include 1. Payment of loss, provides compensation or indemnity as may be necessary. 2. Reduction of uncertainty by covering possible loss exposures. 3. Ensures compliance with the legal requirement, statutory and contractual requirements. 4. Promotes loss control activity. 5. Efficient use of insured's financial resources after premium payment, and 6. Reduces social burden through compensation of insured accident victims. Insurers undertake or promise to indemnify or compensate insureds in the event of a loss covered by the insurance policy in exchange for premium payment. Insurers are expected to make good the insured's loss based on the term and conditions of the insurance contract. It is, therefore, essential for insurers to have sound claims management system. Insurance claims. An insurance claim is a formal request by an insurance policyholder to an insurance company to indemnify or compensate him after a loss based on the insurance contract terms and conditions. The insurance company will review the claim to ensure its validity and then pay the insured or requesting party, on behalf of the insured, subject to the terms and conditions of the policy. Insurers know that a good claims handling system will deliver tangible results for both commercial and personal lines. Hence, to keep pace with the challenging market environment and competition, insurers should, 1. Invest in transforming their in-house core claims legacy systems, 2. Cultivating data analytic capabilities, and 3. Improving customer relationships across all touch points. The non-life insurance industry is witnessing shifting trends across policy administration and claims, which are the two core functions in insurance. The claims process is the defining moment in a non-life insurance customer relationship. To retain and grow market share and improve customer acquisition and retention rates, insurers are focused on enhancing customers' claims experience. In a highly competitive insurance market, Differentiation through new and more effective claims management practices is one of the most important and effective ways to maintain market share and profitability. Insurers can transform claims processing by leveraging modern claims systems that are integrated with robust business intelligence, document, and content management systems. This will enhance claims processing efficiency and effectiveness. It can benefit the insurers both operationally and strategically by enabling them to reduce claims costs to improve their combined ratio, improve claims processing efficiency, and drive customer retention and acquisition. Today in many insurance companies, the claim process is built on the following 4 tools. 1. Claim documentation and content management tool. 2. The use of mobile-based and smartphone-based technology solutions for claim processing. 3. Straight-through processing, STP, to minimize the delay. STP is an automatic solution for seamless electronic transactions and interactions without manual intervention. STP is commonly used by financial institutions to reduce transaction time and stock markets to facilitate seamless initiation and settlement of securities without manual intervention. 4. Modern seamless and robust claim processing platform. The importance of claims management in the insurance sector. The importance of good insurance claim management includes: 1. Efficient claims management is vital to the success of both large and small firms in the insurance industry. 2. Settlement of claims. 3. Detection of fraud. 4. Lowering of costs. And 5. Avoidance of litigation. Goals of an insurance claims function. The essence of an insurance claims function is to ensure: 1. Compliance with contractual promises and supporting the insurer's financial goals. 2. The satisfaction of the insurer's obligations to the insured as specified in the insurance policy. 3. Managing claim functions expenses, establishing spending policies, using appropriately priced providers and services. 4. Claims activity monitoring and measurement of the effectiveness of claim department activities. 5. Claims element analysis. This involves individual analysis for claim indemnity payments, claim expense payments, deductibles set off from claim payments, separately collected deductibles, and subrogation collections. Roles of insurance claims personnel. Insurance claims handlers are responsible for managing claims from the claim notification stage to the settlement stage. Depending on their level of experience and knowledge, they may investigate potentially fraudulent claims and undertake a range of loss-adjusting activities. Depending on the experience and level of responsibility, the roles of insurance claims personnel include: 1. Guiding policyholders and offering advice on insurance claims procedure. 2. Processing of reported insurance claims and handling of claims complaints. 3. Collection of information and documents for claims processing. 4. Liaising with tradespeople from a network of approved professionals and arranging for the repair of the item insured. 5. Monitoring of claims handling progress to ensure that genuine claims are settled promptly. 6. Investigation of potentially fraudulent claims and identify reasons why the total claim should not be paid. 7. Building relationships with loss adjusters, forensic accountants, solicitors, and other claims-related professionals. 8. Involvement in loss adjusting activities and legal discussions on claims being handled. 9. Seeking legal recovery of settled claims. 10. Ensuring that customers are treated fairly to ensure excellent service based on the industry and company guidelines. 11. Management of claims handling team at the managerial level. Skills and qualities of claims personnel. For insurance claims personnel to be adequate, it is essential to possess requisite skills and qualities. Here are some of the essential skills and qualities insurance claims personnel should possess. 1. Customer service skills. 2. Negotiation and decision-making skills. 3. Communication skills and a confident disposition when dealing with people, often under challenging circumstances. 4. Organizational and time management skills. 5. commercial acumen. 6. The ability to think strategically. 7. Initiative and the ability to adapt quickly to different situations. 8. Good numeracy and literacy. 9. Interpersonal skills. 10. Discernment and the ability to assess a situation objectively. 11. Attention to detail and sound report writing skills. Factors influencing insurers' claims environment. Here are the factors influencing insurers' claims environment. 1. Regulatory requirements such as status and regulation requirements, insight, foresight, adaptability, and agility. 2. Technological advancements to enhance customers' satisfaction and loyalty. The ability to access internal and external data, advances in mobile technology, and lower-cost voice technology provide companies with multiple opportunities to deliver enhanced customer service. 3. Delivering on developments such as real-time email alerts and other technologically enabled service upgrades are part and parcel of today's marketplace across the industry spectrum. Moreover, yesterday's innovation is today's expectation. 4. Promptness in handling and settlement of claims. Social media's capacity to spread the word when a customer has a problem can cause unwelcome attention when a claims experience goes wrong. Dimensions of claims transformation. The claims system should be sound. Hence, it is essential for insurers who have a weak claims system to transform their claims processing systems. There are 5 major dimensions of a successful claims system: customer experience, operating model, integrated management, advanced technology, and information and analytics. Let us highlight the implications of these 5 dimensions. 1. Customer experience. No considerate insured will report a fictitious insurance claim. Hence, the need for sound claims management. 2. Operating model. When a customer interacts with an insurance company, he or she should feel seamless. The insurers should ensure its operating model can support that experience. 3. Integrated management. The claims function should be integrated with other departments within the company. This should be bottom-up from claims and top-down throughout the company. 4. Advanced technology. Investigate new solutions, replace outdated systems, and commit to providing customers with access to tools that use cutting-edge technology to improve their experiences. 5. Information and analytics. Use data analytics to develop customer insights and make changes to provide service beyond their expectations. Recruit, train, and nurture talent to help meet this goal. Benefits of a good claims handling process. The benefits of successful claims handling process and system include: 1. Offering superior claims and policy service to enhance customers' retention. 2. Distinguish the company in the marketplace to improve brand recognition. 3. Boost efficiency and cost savings by analyzing both internal and external information to reduce costs. 4. Improve productivity and fuel continuous improvement to enhance its competitive capability. 5. Retain talented and experienced claims staff to maintain a dynamic, talented, trained, and well-rewarded workforce for superior customer service. Obstacles to the transformation of claims handling system. Here are some obstacles to the transformation of an insurer claims system. 1. Legacy data and analytics challenges. This obstacle can be overcome by engaging sophisticated and well-thought-out analytics. 2. Budgetary constraints. This obstacle can be overcome by considering return on investment when making decisions. 3. Functional silos. This obstacle can be overcome by using integrated processes, well-orchestrated data models, and integrated systems. 4. Lack of aligned, properly trained talent. This obstacle may be overcome by providing necessary training and deploy change-focused communications. Consequences of an untransformed claims system. Considering the need to transform the claims handling process, insurers that fail to transform their claims handling processes may suffer the following consequences. 1. Outdated systems and operating models. 2. Ineffective competitive strength. 3. Inability to leverage fast-changing data and technology developments and the opportunities they support. 4. The result, poor customer relationships and inability to ensure customers' loyalty. Implications of customers' experience on insurance claims processing. Customers should be treated well to ensure their continued loyalty and patronage. Here are implications of customers' experience on the claim handling process of insurers. 1. Customer claims experience establishes how insurers will deliver on their promises to make good genuine claims. 2. Insurance companies' leadership should understand the impact of the customer experience on the overall claim outcome. 3. Claims handling. The transformation process should focus on using technology, process redesign and training to improve the customer experience. How to improve insurance claims handling process. Here are ways of improving a claim handling process. 1. Develop an effective claims management strategy to ensure a satisfactory good customer experience. This can be achieved by establishing the overall goals, principles, and objectives for the claims customer experience to align with the overall carrier customer experience strategy. Furthermore, market analysis, including surveys, interviews and focus groups, should be conducted to determine how to serve customers' desires and needs and identify the industry and cross-industry best practices. 2. Develop a sound framework and gap analysis to strengthen the company's claims handling system. The company should create a detailed capability analysis including pain points and handoffs across the customer experience to ensure good pre-claim, first notice of loss, assignment, adjudicate, settlement, close, and post-claim procedures. The outcome of the analysis will enable the company to understand the current customer experience and the perception of the company's claims handling system. Using the outcome of the analysis, the company will develop a detailed overall customer's experience, thereby improving its claims handling process. 3. Map dependencies. The company should determine how its customer claims experience impacts on company's claims operating model, management strategy, technology strategy, information and analytics strategy, and the overall claims transformation program. The company should also use analytics to identify and examine its customers' interactions with the company to overhaul and improve its claim handling process. The outcome of the map dependencies will help the company establish a continually monitored process and review, if necessary, to improve the company's claims handling process. 4. Implement improvements. Insurance companies should train their claims adjusters to ensure a good customer experience based on trust, efficient operations, and a good brand. This will help the company develop a good rapport with its customers and engage appropriate technologies to drive improvements based on customer feedback. Steps of the insurance claims process. The insurance claim process typically involves 6 main stages. The policyholder needs to collect relevant documents, including receipts, original invoices, and proof of ownership, photos and accounts of the event or damage, and familiarize himself with the insurance claim process steps. Here are the 6 basic steps of an insurance claims process. Step 1. Report insurance claim to the insurance company. The first step is to report the insurance claims to the insurer through insurance brokers or report directly to the insurer, if the insurance was not purchased through insurance brokers. An insurance broker is the primary contact of the policyholder in an insurance contract because they understand their clients' situations and how to secure the best bargain for them. Once the insurance broker has a detailed list of all the damaged or lost items and photos or videos that help explain the circumstances, the policyholder can report the claim by phone, but many insurance companies also allow the report of claims online. After receiving the claim, the insurer will appoint a loss adjuster who will be the main point of contact throughout the process. The loss adjuster will follow up with the insured or his insurance brokers during the claims processing. Step 2. Claim investigation. After the claim has been reported, an adjuster will investigate the claim to determine the amount of loss or damage is covered by the insurance policy. The adjuster may wish to visit the scene of the loss or have someone do so on their behalf. They may also need the insured assistance in identifying witnesses or other parties that might be relevant. The adjuster will let the insured or his brokers know what they need to complete the investigation. The adjuster will also identify any liable parties, and the insurance brokers can assist the process by providing any witness information or other parties' contact information. Step 3. Review of policy to determine the insurance coverage. The adjuster will analyze the insurance policy to confirm that the reported loss is covered, partially covered, or not covered with the facts in hand. Once the investigation is complete, the adjuster will thoroughly examine the insurance policy to determine what is covered and excluded by the insurance policy. The insurer will notify the insured on what is covered, the adjusted claims amount, and the policy excess or deductible. Step 4. Evaluation of the damage. To accurately evaluate the extent of the damage, the insurance adjuster may hire appraisers, engineers, or contractors to lend their expert advice. Once the evaluation is completed, the adjuster will present a list of preferred vendors to help with repairs. However, the insured is not obligated to hire the recommended vendors, but the recommendation would save the policy time and cost in dealing with or settling the claim. Step 5. Repair and replacement. Indemnification can commence after establishing the policy coverage. This may be as simple for small claims, like a water-damaged laptop, as the insurance company can replace the damaged laptop with a new one. For more substantial losses, it might be necessary to involve contractors. The adjuster may be able to provide a list of recommended contractors to hire for the repairs. The insurance company will often make part claim settlements in advance to facilitate the commencement of the repair. Step 6. Final payment. The insurance company will settle the claim after the completion of repairs and replacements. The insurer will settle the claim or pay the outstanding repair costs, subject to the policy limits. The amount of time it takes to settle the claim will depend on the complexity and severity of an individual claim. In complex claims, the final payment stage may involve negotiation between insurers and insureds about who pays for what. If the insured agree with the insurer's offer, the insurer will settle the claim and complete the claim processing. If the insured disagreed with the insurer, then formal insurance claims dispute process will commence. Now, let us discuss insurance disputes. Insurance dispute. An insurance dispute arises when an insurance company and the policyholder disagree on the terms of a settlement. A dispute can happen for many reasons, but the most common are claims denials and slow payouts. The insurance company may deny the claim outright, offer less than the claimant believes his or her damages are worth, or delay payout without a valid explanation. An insurance company might also extend a settlement negotiation longer than it should reasonably go on. A policyholder can enter a dispute with any insurance company regarding any insurance. Disputes may arise about auto insurance, property insurance, vessel insurance, for example, ship and aircraft, life insurance and other types of insurance policies. Although insurers genuinely endeavor to provide a fair and efficient service, there will be an issue of dispute from time to time. Inevitably, most disputes arise at the time of claims. Insurance claims disputes can be categorized into two, namely: 1. Dispute on the point of law or liability. This entails disagreement between the insured and the insurance company on the meaning and interpretation of the insurance policy. This dispute centers on disagreement on the acceptance of liability by the insurance company based on the terms and conditions of the insurance contract as contained in the insurance policy documents. 2. Dispute on the quantum or amount of liability. This entails disagreement between the insured and the insurance company on the claim amount payable by the insurer. How to resolve insurance disputes. Ways of resolving insurance disputes include: 1. Negotiation. 2. Litigation. 3. Arbitration, and 4. Alternative dispute resolution, ADR. 1. Negotiation. Disagreement may be settled by discussion between the parties concerned, resulting in one party's point of view of an amicable mutual settlement. Negotiation entails direct or indirect communication whereby parties who have opposing interests discuss the form of any joint action which they might take to manage and ultimately resolve the dispute between them. Negotiation is the most basic means of resolving insurance disputes. 2. Litigation. Litigation is the act, process, or practice of settling a dispute in a court of law. The court proceeding may be necessary if the dispute cannot be resolved by discussion between the parties. Insurers usually regard this as a last resort entered only when the dispute is on the point of law or when an important point is at stake. 3. Arbitration. Arbitration is a complementary system of legal procedures and not an attempt to oust the court's jurisdiction. Arbitration is the process of using a third party to settle a dispute instead of taking the case to court. Both sides rely on the arbitrator, an unbiased individual or panel, to come to an appropriate decision based on the facts of the case. Dispute on the quantum of liability must first be referred to arbitration. The arbitration decision is legally binding and includes all the information about the case, along with the arbitrator's decision regarding fees, damages, or disciplinary actions to resolve the case. The resulting judgment is called an arbitration award. The insured, however, has the right to proceed to litigation, court proceedings, if he is not satisfied with the arbitration's decision. Arbitration typically resolves cases faster than courtroom proceedings. Arbitration is a more straightforward process, and it is less expensive than going to court. An arbitrator can be a person, or an organization not affiliated with the parties, that is insured and the insurance company. An insurer cannot insist upon arbitration conditions unless the policy contains an arbitration condition. The insurer cannot insist on arbitration on claims from third parties. Likewise, the insured has the right to proceed to litigation, court proceedings, if he is not satisfied with the arbitration decision. 4. Alternative dispute resolution. Alternative dispute resolution, ADR, is a method aimed at lightening the caseload of courts of law. It is a less formal procedure where the parties themselves determine the ultimate solution through mediation rather than by a judge or arbitrator. A mediator will be appointed by mutual consent of the parties. It is the mediator's job to facilitate discussion through a series of meetings and encourage the parties to bring various aspects of the dispute to a point where there is mutual understanding and acceptance. The solution is often a compromise that is acceptable to both parties. ADR can be used to assist in all manner of disputes, including complaints to insurers. It can have a particular benefit in disputes between insurers and commercial policy holders where there is nothing available before complete arbitration and court action. Principles and conditions of insurance claims processing. Insurance claims should be handled and processed based on the policy terms and conditions. Some general principles and policy clauses apply to insurance claims. Most of the applicable principles and clauses are contained in the insurance policy, which embodied the contract terms and conditions. Let us discuss general principles and clauses applicable to insurance claims. 1. Notification condition. Notice of claim provision is a clause in an insurance policy requiring the insured to promptly notify the insurer if a claim is made against the insured. Insurers need to know about a possible claim early to start to take action to reduce the consequences. There may be excellent reasons for requiring immediate notification. For example, in riot cases, insurers will have limited time to notify the police authorities if they are to take advantage of recovery prospects under the Riot Damages Act, 1886. Insurer notification condition places a greater onus on policyholders to inform them of any incident likely to give rise to a claim at the earliest opportunity. One or two insurers have imposed strict notification time limits, the breach of which could result in a repudiation of liability. An insurer does not call for notification other than ensuring reasonable and due diligence practice. The notification condition requires the insured to notify the insurance company in writing of any accident or loss that may give rise to a claim. Letters, claims, writs, and summons received by the insured must be presented to the insurer for the necessary attention. The insured should also notify the insurer in writing of any impending prosecution, inquest or fatal inquiry in respect of any occurrence which may give rise to a claim under the policy. In case of theft or other criminal act that may be the subject of a claim under the policy, the insured must notify the police and cooperate with the company to secure the offender's conviction. The notification condition is essential because the insurer must be aware of all claims at the earliest opportunity. 2. Insurable interest. Insurable interest constitutes the legal right to insure arising out of a financial relationship recognized under the law between the insured and the subject matter of insurance. Perhaps the one principle that does not appear in the policy wording itself is an insurable interest. Insurable interest is one of the legal principles of insurance. Any person can benefit from an insurance policy. One of the essential ingredients of an insurance contract is that the insured must have an insurable interest in the subject matter of the contract. Insurable interest may arise through ownership, through contract, under common law and statute. The insured must show that he or she has an insurable interest in the subject matter of insurance, that is, the item or risk insured. In other words, the person must demonstrate that the subject matter exists and that they will benefit from its continued well-being and will suffer financially from its loss. Without an insurable interest on the part of the insured, insurance would be a mere wager and legally unenforceable. The term subject matter of the contract means the pecuniary or financial interest, that is, the insurable interest, a person has in the subject matter of insurance. While the term subject matter of insurance refers to the risk or item insured, the subject matter of an insurance contract may be a property, an event that may create liability, potential liability which is insured, or pecuniary interest of the insured in a property. Consequently, insurable interest is relevant in insurance claims processing to ensure that the insured has the legal right to insure the item, the life assured, property or event covered by the insurance policy. 3. Indemnity. Indemnity is one of the legal principles of insurance. Indemnity is a mechanism engaged by insurers to place the insured in the position he was before the loss. The sole purpose of insurance is the provision of indemnity. The essence of the indemnity principle in insurance is to indemnify the policyholders in the event of losses, this is to place the insured in the position he was before the loss. The principle of indemnity applies to contracts of indemnity, but it does not apply to benefit contracts. For example, life insurance, sickness insurance and personal accident insurance are not a contract of indemnity, but they are benefit contracts. The claim payment is benefit and compensation, not an indemnity. This is because life and health cannot be valued in monetary terms. Hence, it is impossible to place the insured in the position he was before the loss under benefit contracts, including life insurance, sickness insurance and personal accident insurance. The principle of indemnity is usually stated in the operative clause of insurance policies. As much as the insurer is bound to provide full indemnity in case of any loss, 6 factors might prevent or limit the insured from obtaining full indemnity: sum insured, franchise, excess, average, limit, and deductible. There are also some exceptions to the principle of indemnity, including life insurance, personal accident insurance, reinstatement memorandum, new for old policy, agreed valued policy, and agreed additional cost. Subrogation and contribution are corollaries of indemnity. I would suggest that you see our video on principles of insurance to understand the legal principles of insurance and their applications. 4. Contribution. Contribution is the second corollary of indemnity. Contribution is the right of an insurer after settlement of a claim to call on other insurers who are liable but not equally liable to share the cost of an indemnity payment. The common law allows the insured to recover his total loss from insurers, subject to the sum insured and policy limits. On the other hand, the contribution principle ensures that insurers or insurers who have paid a loss recover a proportionate amount, known as the rateable proportion, from other insurers who are also liable for the same loss. It means that each insurer will pay only its share. If the insured wants full indemnity, he should lodge Prop. proportionate claims with the other insurers appropriately. Just like the principle of indemnity, contribution does not apply to benefit contracts because the contribution is a corollary of indemnity. The principle of contribution has two meanings in insurance which arise from the principle of indemnity. The more obvious meaning is how two or more insurances will contribute to the same loss to ensure that the policyholder does not get more than an indemnity. Insurance policies contain either contribution or non-contribution clauses and sometimes both. However, the combined effect of having such clauses in any two policies will invariably lead to equitable sharing of the claim payment by the insurers. The other usage of the term contribution relates to betterment or improvement. Betterment contribution is not applied as often these days as it was at one time. This may occur where, for instance, the condition of the subject insured of insurance, that is, the item insured, is better after the loss and repair than it was before the loss. The proper interpretation of the law will call for betterment only where the repair has enhanced the value of the insured item. The following conditions must be fulfilled before the application of the contribution principle. 1. There must be two or more indemnity policies. 2. The policies must cover common interests. 3. The policies must cover the same subject matter. 4. The policies must cover a common peril that causes the loss. 5. The policies must be in operation at the time of loss. The policies do not need to be identical. What is essential is that there should be an overlap between the policies, that is, the subject matter should be common, and the peril that causes loss must be the same. 5. Subrogation. Subrogation is the right of an insurer, after indemnifying the insured, to stand in the insured's place against the negligent third party to avail himself of all his rights and remedies, whether already enforced or not. Subrogation is the transfer of the insured's legal rights to recover from the negligent third party to the insurer. In simple language, when an insurance company settles a claim caused by a negligent third party, the insurance company will subrogate the right and remedy of the insured against the third party. If the insured, after having received indemnity, also recovers losses from another, he shall be in a position of gain that is incorrect. This amount recovered by the insured from the negligent third party should be held in trust for the insurer who has given indemnity. Subrogation is a corollary of indemnity. Hence, subrogation is another consequence of indemnity. In common law, the right to subrogation does not attach until indemnity has been provided. Insurance companies, however, incorporate subrogation clauses in insurance policy documents to enable them to stand in the insured's place while handling the claim before the claims settle and to exercise the insured rights of recovery against the negligent party. The subrogation clause gives insurers the right to exercise subrogation as soon as a claim has been reported. This gives control of the claim to the insurer and enables the insurer to pursue recovery from the negligent third party before the actual claim settlement. 6. Reasonable care clause. The law relating to reasonable care clauses in insurance policies continues to change. Generally, insurance policies require policyholders to take all reasonable steps to protect the subject matter of insurance, the item, the life and event insured, against loss and damage. The common feature seems to be that insurers would have to prove a high level of reckless disregard for the safety of the property before they can apply the policy condition to repudiate a claim. In addition, there should be a connection between any breach of condition and the loss under insurance contracts. Consequently, a reasonable care clause is relevant to claims processing because insurance covers losses caused accidentally. 7. Fraud clause. At common law, any policy tainted with fraud is void. Contrast this with avoidable, which is the remedy available to the injured party where there is a breach of utmost good faith, for example, non-disclosure. A policy that is void in law is treated as though it never existed. Either party has rights or remedies under it, and the courts will not recognize its existence. Fraud poses a severe risk to insurers and policyholders. Fraudulent activities committed within or against an insurer can adversely affect the company's financial soundness and reputation. Insurance frauds indirectly impact policyholders by increasing the premium payable due to increased claims handling costs and payment of fictitious claims by insurers. Insurance regulators should take a severe view of fraudulent activities and ensure that all insurers undertake sound risk management practices to effectively deter, prevent, detect, report and remedy insurance fraud. Besides tax fraud, insurance fraud is the most practiced fraud in the world. Insurance fraud exists when individuals attempt to profit by failing to comply with the terms of the insurance agreement. The insurance business is susceptible to fraud, but the extent of insurance fraud can be reduced through sound fraud management. By fraud clause in an insurance policy, an insurance company has the right to decline or repudiate fraudulent claims, including exaggeration and submission of forged documents. A fraudulent claim is void at law, and the insured does not have the right to reclaim the premium paid. Fraud comes in different shapes and sizes. It may be a simple act involving one person or a complex operation involving many people from within and outside the insurance company. There are two broad categories of insurance fraud: 1. Policyholder claims fraud, and 2. Intermediary fraud. 1. Policyholder claim fraud. This includes frauds perpetrated by insurance policyholders, wholly or in collaboration with third parties, against insurance companies. 2. Intermediary fraud. This includes fraud perpetrated by intermediaries against the insurer, policyholders, customers, and beneficiaries. 8. Cooperation condition. The cooperation clause in an insurance policy ensures that the insured cooperates and support the insurer to ensure successful claims processing. Once an incident has been reported to the insurers would require the cooperation of the policyholder by providing necessary information and documents to process the claim. The cooperation required would cover many aspects, such as passing on the third party, legal documentation, and assistance in any criminal or civil court case. 9. Admission of liability condition. The insurer's position will be prejudiced if the policyholder admits blame to a third-party claimant without the insurer's consent. Consequently, the admission of liability condition, contained in the insurance policy document, imposes a duty on the policyholder not to admit, offer, promise payment or indemnity shall be made or given by or on behalf of the insurer without the company's written consent. Ideally, the insurer has the right to subrogate the insured's right against the negligent third while handling the claim. 10. Arbitration condition. Arbitration condition in the insurance policy emphasizes that dispute arising on the difference in the amount of claim payment must be referred to an arbitrator appointed by the parties based on the appropriate statutory provisions. The arbitration decision on the award claim amount shall be a condition precedent to the right of action against the insurance company. The purpose of the arbitration condition is to protect an insurance company that is not obliged to pay a claim under the terms of the policy. The implication is that disputes on quantum or liability amounts must first be referred to an arbitrator before any legal action can be taken against the insurer. Conclusion. In this video, we have discussed insurance claims and the management of insurance claims. Insurance products are intangible products. Insurers undertake, or promise, to indemnify or compensate insureds in the event of a loss covered by the insurance policy in exchange for premium payment. Insurers are expected to make good the insured's loss based on the term and conditions of the insurance contract. Hence, insurers need to have sound claims management system. Moreover, insurers are aware that sound claims handling system is beneficial to retain existing customers and attract new customers. I hope the video is educative and beneficial to you. We love to hear from you. Kindly post your comments below in the comments section. If this video has been educative and beneficial to you, then give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.